So thank you so much everybody for coming for this session on tax refund hacks, how to beat the CRA at its own game. I know there are two things. There's a saying that goes that there are two things you cannot escape in Canada: death and taxes. And yes, we thank God that we are in a society where we have things working, and it's because of the taxes we pay and all that. That's why we have everything working. We have lights, we have good roads, and all the amenities working for us, right? But even at that, we still want to retain as much as we can of the hard earned money. And one of the reasons why we are having this session is to help you see ways in which you can retain your money. And another thing that we are very passionate about, my name is Oka and my co-host name is Grace, is that over the years we've been practicing as licensed advisors, we've met clients that will tell us, "Oh, we wish we knew this earlier. We wish we had started this earlier. I've been in Canada for the past 16 years and I didn't know this," right? We want to educate people. This is one of our passions, that we want to educate our community so that we don't have people regretting 10 years down the line that they didn't have some of this information that we're going to be sharing in this particular session and in all the sessions that we're going to be having, because we're going to be having multiple sessions over the year, and we're going to be touching on a lot of topics related to the finance sector in Canada. I live in Alberta. Grace too is in Alberta. I live in a very, very small town called Bassano. If you're in Alberta, you may or may not have heard about this town. It's a very small town, 1,800 people. We are the only black family in this town, so please pray for us. Grace lives in Calgary, and we've been business partners for a while, and she's my very good friend also. She's going to be handling the chat session. And if you have any questions, please put it in the chat box and we'll handle it after the session is over. Now, like I mentioned, we are very passionate about educating people. And this session is about getting refunds from the CRA. And I know a lot of times when we get the money, it looks like free money, and the next thing we want to buy our favorite purse that we've been eyeing for a while. We want to flex and all that. Yes, all work and no play makes Jack a dull boy, right? But one of the main reasons why we're holding this session on how to save on your taxes is saving towards or investing that money towards your retirement. The reality in Canada is that time flies. I don't know if they are working in a different time zone, but time flies. I remember in 2019 when my parents saw us off to the airport to come to Canada, and it's over 5 years already. And a lot of times, especially for new immigrants coming, the only thing that we are thinking about is how to settle. And I know it can be very difficult, especially the early part of settling, right? But we also have to put into consideration what we are going to do after we retire. And with the way time flies, our retirement will be staring us in the face in no time. Now, when we talk about retirement, we're going to be looking at how much we would need to retire and how difficult it will be if we don't start planning our retirement early. When it comes to investing, we know that it takes time for money to grow. No matter how fabulous your the rate of return of an investment is, if you don't give it time, it will not make any difference. If you have a $10,000 today, and you get an investment that will give you a return of 100%, by next year you only have $20,000. But do you know that if you invest $200 every month, over time you can get tens of thousands or hundreds of thousands or even millions, depending on how long you have invested the money the invested in. And delay can actually cut your savings by up to half. Now, when we talk about how starting early can impact your investment, let's look at two individuals. Let's look at Jack and Jill. Jack started to invest when he was 25. He invested $200 every month in an investment that was going to be giving him an average of 7% every year. And he invested for just 10 years. So over the cost of his investment, he had just contributed $24,000 because he invested for just 10 years and he stopped. He left his investment, and at the age of 65, his investment had grown to $282,000, even though he just invested $24,000 for the first 10 years. Now let's look at Jill. She waited for 10 years and she started investing at the age of 35. The same $200 in the same investment that was going to be giving her 7% to on average. And she continued to invest from the age of 35 to the age of 65, meaning she invested $200 every month for 30 years. And in all, she put into her investment $72,000. But Jill, at the age of 65, has grown her investment portfolio to $245,000, less than Jack that just contributed $24,000. So you can see the impact of investing early into an investment, right? Especially when you're investing towards your retirement. Now, that being said, I do not want to discourage anybody. The fact that we didn't start, or people that haven't started already, we shouldn't just throw in the towel and say, because I didn't start in time, so I'm not going to start at all. $245,000 is nothing to scoff at, right? And there's an ancient Chinese proverb that said the best time to plant a tree was yesterday, but the next best time to plant that tree is today. So even if we've not started, the best time to start is now. Now, another thing that people don't put into account when it comes to retirement is how much they actually need to retire. And that is what we call your financial independence number, how much you need to comfortably retire. It's a bit more complicated and all that, but in simple terms, if you put into factors like your living expense, your lifestyle, inflation, and you get an approximate number of how much it will cost you to live per year, you multiply that by the projection of how long you think you would live. So if you retire at 65 and in your family, okay, you have long life and you know you're going to live to the age of 90, that means you're going to be living for the next 25 years on, say, no income per se. Because if you retire, you're not going to be working, right? But remember, the fact that you retire doesn't mean that expenses come to an end. You still have to eat, you still have to pay, even if you've paid off your mortgage, you still have to pay property tax, your bills, light, water, and all that. So all that, if you put that all into consideration, you'd see that it is not cheap to retire. So if, for example, you need, after you calculate everything, you need $50,000 per year to live a comfortable life in retirement. For the next 25 years, you're going to need an investment portfolio of about $1.25 million to live comfortably at $50,000 per year. If we're just even looking at cost of just feeding, and you say, okay, in a day, I'm going to be eating, my cost of feeding is going to cost me just $20 per day. You would realize that for the next 25 years, you will need about $182,500 just to retire, just to eat during retirement. And if we're not actively and aggressively saving and investing towards retirement, we might be faced with a harsh reality. Some people cannot even afford to retire. And that was one of the will I say shockers when I came to Canada. I went to Walmart, Superstore, and the rest, and you see people that are called senior citizens actively working. Yes, some of them were working because they don't want to like just sit at home and all that, dignity in labor and all that. I'm not like saying it's wrong, but I want us as a community to work because we want to work, not because we need to work when we get to retirement. Now, Another shocker that I found out when I got to Canada is CPP is not enough. When I was preparing to migrate and all that, we heard that when you retire, the Canadian government will pay you a pension. So I was like, flexing. After retirement, we just flex, right? But when I came here and I got into this line of work and with research and everything, you now realize that CPP is not enough. In 2025, the maximum anybody can get for CPP as pension at the age of 65 is $1,433. And that is if you have worked for the past 40 years in an occupation that has been paying into the CPP. The average is that people get on average is $808. I've heard of someone that got $18 as his CPP. With how expensive things are, even if we fall in the category of getting the average, which a lot of us may not fall because a lot of us are coming into Canada in our 30s, some of us in our 40s. How long do we have to work before we can even get this amount, the average in CPP, right? So that is why we are bringing this particular session to you so that when we get these refunds from the government, we just don't use it as flexing money. We use it to save towards our retirement. Now, to the main topic. I know I've been blabbing for a while, so let's get to what everybody came here for. Tax refund hacks. There are a lot of tax refund hacks, but the 5 main popular ones are: 1, contributing into registered accounts; 2, maximizing your tax credit; 3, claiming work-related expenses; 4, starting a side business; and 5, claiming public transit incentives from the government. Now, what are registered plans or registered accounts? We live in a society where taxes are a huge burden to the populations and to the citizens, right? But the government, knowing that this is a huge burden, has made certain accounts available that their citizens, or we as citizens, can use to save for different key aspects of our lives. And this account provides tax advantages. There are accounts that you can use to save towards retirement, accounts you can use to save towards like emergency funds, accounts that you can use to save if you want to get your first home, accounts you use to save towards your children's education. But today we're talking about how to get refunds from taxes, right? So we're going to be focusing on the 2 accounts that give us those tax advantages of getting refunds from the government. All the registered accounts are very important, and in our subsequent sessions, we're going to be dealing with them one after the other, just to show you how they help you to save in taxes. But today we're going to be dealing with the RRSP and the FHSA. Now, what is the RRSP? The RRSP is just an acronym for Registered Retirement Savings Plan. Now, what is the purpose why the government brought up the RRSP as an account that can be used, right? This account is for you to be able to save and invest now that you're actively working and in a high income bracket, because whatever you put into your RRSP helps you to reduce your taxable income now that you're in a high tax bracket. And in future, when you now are retired, you obviously are no longer working or earning income, your tax bracket would definitely drop. And as you withdraw from your RRSP, you are withdrawing at a lower tax rate in retirement. Now, what are the tax benefits for this plan? Like I mentioned, the contributions that are put into the RRSP are tax deductible. So it reduces your tax your taxable income. So let's go into a tax calculator to see how this works. Now, this is one calculator I like to use. It's well simple, and it helps you to calculate your taxes. It's a simple one. If you have a more complex tax situation, this may not help you a lot. But for this example, just a simple example, let's just use this to see. Can you guys still see my screen? Well, simple. Okay, so I live in Alberta, and let's say I made money this year and I made $100,000 in income. If I don't have any other deductible that will help me reduce on my taxes, sorry, I'm going to pay a total tax of $26,450, meaning my after-tax income is $73,550. This is what it is. If you're an employee and you don't have any other tax deductible, this is what you pay. So you're going to have to pay about $27,000 or $26,000 to the government as taxes. But if I have a taxable room of, say, $10,000, and I'm able to put $10,000 into my RRSP, saving and investing it towards retirement, my tax owing, or the tax that will be deducted, is 23,400. So if initially, right, the for an employee your tax is deducted from source, if initially these taxes were already deducted, you will get a refund of 3,050, because the government automatically recalculates your taxes like someone that earned $90,000. So they'll say, oh, he paid $10,000 or she paid $10,000 into her RRSP. In fact, she made $90,000, and we overcharge her like she made $100,000. So we're going to return back the overage we took from her, which is about $3,000. Now, when a lot of us get this $3,000 back, it looks like free money. No, it's not actually free money. It's actually your money that the government has returned back to you. And if we just spend it anyhow, yes, it's our money, we can spend it anyhow we want. But like I said, the main aim for this session is to teach us how to save on taxes to invest towards the future. Now, another taxable tax benefit that the RRSP gives is that the investment that is done within this account grows tax-free. This particular benefit is applicable to all the registered accounts we looked at earlier. All the registered accounts have the tax benefit of you investing within that account, and the investment grows tax-free. If you were to invest or save in a non-registered account, even as simple as your savings account, you put in money into your savings account, and the money, the interest, no matter how tiny that interest is, and it grows every year, during tax season, you receive a tax slip to pay taxes on it. So if you're using a non-registered account to invest through, it's like moving 2 steps forward and 1 step back, because every year you get taxed on the interest that has grown on your account. Now, another tax benefit that the RRSP gives is that at withdrawal, you are taxed at your tax rate. So the reason why this account was made is that you would save towards your retirement, and at retirement your tax bracket should be lower. Remember, I said should be lower. There are some people that even at retirement, because of the kind of investments and businesses you would have set up, your tax bracket may not be lower. So put that into consideration too. Now, the contribution limits, because all the registered plans that we listed earlier have their own limits. Now, the contribution limit for the RRSP is 18% of your previous year's earned income, up to a maximum of 31,560 for 2024. So what this means is that if you earned $100,000, 18% of your $100,000 will become your contribution limit. For people that just came into Canada, you would not have an RRSP room because your RRSP room is based on your previous year's income. Now, the best way to actually know your contribution room is to check my CRA account. Why I said that is that sometimes the calculation is just a bit off, and if you over contribute, you have a penalty, you'll be penalized. So the penalty I'm going to talk about that, I think, in the next slide. The penalty for over contributing is 1% of the over contribution room every month until you take out that extra over contribution out of your account. So you have to be very careful. So it's better you wait for your my CRA account to be set up and you check what your RRSP room is. Now, the RRSP has two special features. Remember I said whenever you're taking out the money, you're going to be taking it out and you're going to be taxed, right? But there are two situations in which you take out money that you won't be taxed. When you need to buy your first home, you can withdraw up to $35,000 from your RRSP tax-free. You won't pay taxes on that amount, even though you are withdrawing the money out. But the catch is that you must pay it back in 15 years. So after 15 years, if you don't pay it back, the 35,000 is just added to your income and you have to pay taxes on it. But if you want to buy your house without paying, without using after tax dollars, this is a very good strategy to put in place. Put money into your RRSP and take out the money to pay towards your first home. Now, the catch for these two is the money you put into your RRSP has to have been in the RRSP for at least 3 months, 90 days, 3 months before you take it out, and it qualifies for you to take it out for the home buyer's plan. If not, you take it out and you'll just be taxed. So you have to put the money in, wait for 90 days before you can take it out. Another way you can take out money from your RRSP without paying taxes on it is if you're going to be using it for education, using the lifelong learning plan, and you can withdraw up to $10,000 per year to pay towards your tuition, books, or anything concerning your education, but you must repay back the amount within 10 years. Now, the good thing with the RRSP is that it gives you extra time to contribute into your RRSP. So the deadline to contribute into your RRSP, if you want to claim it on 2024, because I know we're about to start filing our taxes for 2024. So if you want to claim deductions for your RRSP in 2024 for the RRSP, you have up until 3rd of March 2025 to contribute into your RRSP. This date changes every year, so you have to be careful. Last year, I think it was 29th February, was the deadline. So you have to keep checking to make sure you don't contribute when you don't want to contribute. Now, common mistakes that people make with the RRSP is not contributing early enough. From the earlier slides, you could see the effect of not contributing early. Then withdrawing too soon and paying higher taxes. The reason why the RRSP was made is, okay, contribute into the RRSP, save on taxes now that you have a high tax, you're in a high tax bracket, and then withdraw when you're in a lower tax bracket. So if you withdraw too soon, I understand life happens. We might get into a financial crunch and we need cash. The last place we should think of taking out money is the RRSP, because whatever money we take out from the RRSP is added to our income for that year and we're going to pay taxes on it. So for example, you earned $100,000. If you take out $10,000 from your RRSP, it is calculated like you earned $110,000 and you're going to be paying taxes on $110,000. So make sure that maybe the RSP is the last resort, right? Especially if you're in a high income tax bracket. Then ignoring employer matching programs. If you get into a new job and your employer is telling you, oh, we'll match your RRSP, please take advantage of it, because you're just leaving free money on the table if you're not taking advantage of it. So if your employer is going to match you by, say, 10%, and you put in $100 every month, your employer is going to add $10 on your $100 every month, meaning you are contributing $110. Nobody is going to give you free money in Canada. So if your employer is going to match your RSP, please take advantage of it. Then another mistake that people do is not investing. So if I ask a client, are you investing with your RRSP? The first thing they tell you is yes. The fact that you opened an RRSP account doesn't mean you're investing. The RRSP account is just like your savings or a checking account. If you open an RRSP account and you just put money in there, the money will sit and look at you and keep looking at you. You come back in 20 years, it will sit down and be looking at you. The way you should use your RRSP is that you put money in there and invest money from that account to take advantage of the tax benefit of your money growing within your account tax-free. If you just put money into the RRSP without investing it, it's just like your regular savings account or checking account. Your money won't grow. It will just be there waiting for you. Now, another mistake is over-contributing. I already mentioned that earlier. Over-contributing can be very devastating to your RRSP, because if you over-contribute, the government is going to penalize you 1% per month on the average until you take out that on the overage, until you take out that overage from the account. Now, the second registered account that I said we're going to be talking about when it comes to getting refunds back from the government is the FHSA. The FHSA is an acronym for the First Home Savings Account. The purpose of this account is to help Canadians buy their first home. Now, what are the tax benefits for the FHSA? The FHSA acts like the RRSP in that you have deductible when you make contributions into your FHSA. So if, for example, let's go back to this calculator. Can you guys still see this? Can you see the calculator? Okay. So I live in Alberta. I choose Alberta. And then I make $100,000 in this year, in 2024. And I have contributed $10,000 into my RRSP after checking my room and knowing that I have up to $10,000 in room to contribute into the RRSP. Now I have another room of, say, $8,000 to contribute into my FHSA, and I make that contribution, meaning I have made $18,000 in total, $10,000 into my RRSP and $8,000 into my FHSA. If I had not made any contributions into these two accounts, I would have paid about $26,000 in taxes. But the fact that I made contributions into my RRSP and FHSA, say $10,000 RRSP and $8,000 FHSA, I am going to get a tax refund of about $5,400 as my tax refund, right? So this is a great way to save in taxes and to save towards your home. And remember, when you get the tax refund, you use it to invest towards your future. Now, for the contribution limits that we have for the FHSA, you have the contribution room of $8,000 per year, up to a maximum of $40,000. That means if you're contributing $8,000 every year, you have 5 years to contribute to the limit of this plan. Now, for you, unlike the other registered plans that start to accumulate rooms from the get-go. For the RRSP, immediately you file your taxes, it starts to accumulate room. For the TFSA, immediately you come in as a PR, you start to accumulate room for your TFSA. For the FHSA, you must open the account for you to start to accumulate room. So this FHSA came into being in 2023. If you opened an account in 2023, that means you would have $24,000 in room to contribute into the FHSA, because 2023, 24, then 2025, right? If you did not open up your FHSA room or account, in 2023, it means you will just have 8,000. If you open it this year, it means you just have $8,000 in room. And remember, if you over contribute into any of the registered plans, you have a penalty being applied to you. So if you have not opened up your FHSA account, please open it up immediately, even if you don't have money to contribute yet, so you can start accumulating the room. Because right now, even if you have $24,000 you want to use towards your down payment for your house, you can't put it into the FHSA account to get the tax deductible benefit that this account will provide. You can only contribute $8,000 if you're just opening up your account this year. One of the pro tips that we advise our clients to use is that you can use the FHSA, the contribution in your FHSA, and the home buyers plan from your RRSP, get out money together and pay towards your down payment for your home. Now, another strategy to get tax refunds from the government is using tax credit. Tax credit comes in different ways, but some of the ways that you can get tax credit from the government is Canada Caregiver Credit, where you get tax refund if you support a dependent, your spouse, your child, grandparent, and they have a disability, whether physically or mentally. If you have that, you are able to get some tax refunds from the government. If you have medical expenses, prescriptions from the doctors, or you are referred to like a dentist, and the overall that you've spent on your medical expenses is above 3% of your income, you are able to write that off on your taxes too. Now, if you are going to school and you are paying tuitions, you are able to get that amount to written off during when you're applying for your taxes. Then charitable donations. I know a lot of us from Nigeria. I can say Nigeria. I don't know about the other African countries. We feel a kind of way when they're asking us that, okay, you're getting a tax refund for your offerings and tithes and all that. But this is the land we are living in, and it is in the law that you can get your tax refunds for the donations that you're giving to charitable organizations. So you pay your tithes, you pay your offerings, you give money to charity. Please keep all those receipts, right? If it's above $200, you would be able to get tax refunds from the government. Now, when it comes to tax credit and anything that you're claiming back from the government, please keep your receipts, because the CRA can audit you 5 years behind. So for any, I think it's 5 years or 6 years, I'm not very sure now, but it's within that range, right? For any tax credit or tax deductions you're sending to the CRA, please make sure you have your receipts and keep them safe in case of any audit that happens. 5 years after that, you can throw them away because they won't go backwards more than 5 years. Now, another way to get tax refunds from the government is claiming work-related expenses. So for people that work from home, due to thank God for COVID, right? If you're working from home and you can actually get tax refund for the fact that you work from home. So the space you're using, your utilities, internet and all that can actually be calculated. If you go to the Canada.ca website or just Google how can I claim work from home expenses. There's a way you can calculate the space in which you work and all that, and get a refund back for the fact that you work from home. If you're a union member or you're paying professional fees, you can actually claim that for your taxes. Like I said, remember, please keep all your receipts. Now, if you have to move, you're getting a new job, or you just want to move closer to where it is that you're working, and it is more than you've moved about 40 kilometers, right? 40 kilometers, you can claim your moving expenses. When I and my family moved from Edmonton to Bassano, we were able to claim our moving expenses in taxes because it was more than 40 kilometers. So the people that came to help us move our things into the how much we paid the movers to bring our stuff to Bassano, how much I spent on fuel to fuel the car to drive here, we claimed it on from our taxes for that year. Now, having a side business is also a very, very smart way to get a lot of tax refunds, especially if you also have you are also an employee where you get an income. So if you have a business and your business you are running it from your home, you can deduct certain expenses as business expense. So for example, for myself, I use the basement as my office, and I calculate it to be about, say, one quarter of the house. So I can claim one quarter of the rent. I can claim one quarter of utilities, one quarter of my internet bills, one quarter of if you have a cleaner that comes to clean your house, you can claim all that as business expense. So why this is important is that whether or not I had a business, we're going to have to still pay our rent, our light, our internet bills. But because I have a business, I'm able to claim a portion of that as taxable, as business expense, and that reduces my taxes. My vehicle, I can claim a portion of my repairs, my fuel cost, my whatever I use to work on my car as business expenses. Same with internet and the rest. And if I did any marketing and advertising and all that, I can claim all that as business expenses. So you can have professional development, even meals. I take a client out for dinner, I can claim a part of that as business expense. Also, another way that you can use your side business to claim on your taxes, even though this is not what a lot of people want. Nobody wants to have a loss in their business. So if you're earning an income from a job and you have a business and your business actually made a loss for that year, you can actually use the loss to reduce how much you pay in taxes on your salary. So for example, you made $80,000 in salary, but on your business side, you made a loss of $10,000. Your income was going to be reduced to $70,000, and you're going to pay less taxes on your business, on your income, because your business made a loss. Please remember that this is if your business is a sole proprietor. If your business is structured as a sole proprietor, that's when you can do this. If you have a corporation, you may not be able to do this, because at that point, your business and you as an individual are two separate entities. Now, this is the last part of our presentation, where you can claim, depending on the province you're in, and you use the public transport, you can actually get all your receipts if you're buying weekly, monthly, or yearly passes to reduce the amount you pay in taxes. In Ontario, I think you have to be 65 and over to do that. In Quebec, Manitoba, Nova Scotia, I think it's applicable to all the citizens. But please, if you're in any of these provinces, please go check and be sure of exactly what it is that is applicable in your city or in your province when it comes to claiming public transit incentives. Thank you so much. Thank you for everybody that waited to the end of the presentation. We really are grateful for you coming around. And over to Grace. Are there any questions in the chat?
All right. I am waiting for your questions, everyone. I hope you had a great time. I hope the presentation was clear. And if you have any objections or if you have any areas that you need clarity in, please feel free to unmute and ask us. We'll be